So good morning, or excuse me, good afternoon, I guess it is. All right, I've been going into meetings all day here. So it is a very, very busy time, and I think our timing for this webinar is right on. My name is Chad Staskal, managing partner here at Eagle Wealth Management. I'm happy to have joining us today, portfolio manager with City National Rochdale, Robert Meckstroth, joining us. And so we are, as we started last month, normally we do these webinars quarterly. Well, due to the volatility and due to the amount of just negative news out there being put out by the media outlets, which again, they're paid to sell fear, because fear is what gets people on there. And there are things to be concerned about and things to watch. And that doesn't mean that we are saying there's nothing wrong, but what it comes down to is bringing all of that information into how it affects longer term for your financial plan. So we are going to be doing these monthly here for the next few months until we start seeing a little bit more normalcy to our volatility. We are again recording this, and we'll be presenting this on Monday. We're going to have Robert. He's going to go through a very updated recent slideshow for us, kind of talking about, you know, where are we at right now, the economic outlook, and also kind of talking about kind of the strategies that we're utilizing across our clients based on the most recent data. So I am going to turn this over to Robert, and we're going to go from there. I do want to start off here at the very bottom. At the very bottom of all of your screens, you will see a Q&A, so a question and answer. If you do have questions that you would like to have answered, we're going to try and get through this presentation in between 30 and 45 minutes, but do have some time to be able to ask some questions, answer some questions that you may have. So please feel free to put some questions down there at the bottom, and at the end of the presentation, we'll go through the questions as much as we can. If we can't get through those questions, we will be reaching out to you. One of our financial advisors and or Robert and I will reach out and answer the questions personally with you. All right, I'm going to let Robert get started, and please enjoy. And I will be kind of here probably asking some questions along with you, kind of talking about what clients are talking about, just like, because I know Robert spends his day talking with many individuals as well, based on everything going on. Robert, take it away.
Thanks so much, Chad, and thanks to everyone joining live here today or listening in on the video. It is a fitting time to have one of these discussions with market volatility really ramping up, the Fed with a major rate hike decision yesterday. We will go through all that, and again, just as Chad said, I encourage you to ask questions. You can have the questions anonymous or have your name tied to it in that Q&A box. So if you don't want your name tied to the question, you can ask it anonymously, and we should have time to get to any and all questions as we go through here. So the first slide I'll go through, if you listened to us last month, you've seen this page before. It's the speedometers page, the 6 to 9 month forward-looking view of the U.S. economy. I'm going to talk about some of the changes that we've seen just in the last month, and you'll see some different gray arrows here. The gray arrows on the screen represent where we were in the previous month. So notice how the housing market and fiscal policy have moved in a negative direction, but stock valuations have actually improved a little bit. That's what those gray arrows mean. And if you haven't seen this page before, this is something our firm updates on a monthly basis. We're continuously pulling the data daily, but we publish these every single month with some of the changes. So you notice there's a fair amount of yellow indicators on the page, but this does not look like it did in early 2008. You know, we'll talk a lot today. You know, obviously it's a concerning time for markets. And the number one question I get right now is, are things going to get worse? How bad are they going to get? And I think so far the economic data, as negative as some of it is, does not suggest that this is going to be anything close to like a 2008 type scenario. And I'll talk through why we think that. But first, for those of you who haven't heard this before, inflation is the number one issue right now. That's what caused the Fed to raise rates very aggressively yesterday. The inflation number that came in for May data did not show any improvement. So this is consistent with what we talked about last month. We said, hey, as long as the war in Ukraine is going on, as long as China is locking down aggressively on COVID, you're unlikely to see near-term inflation pressure improve. And we definitely didn't see any improvement in May. And that news that came out that showed, hey, not only has inflation not improved, but it's gotten slightly worse, has triggered the Fed to acknowledge and say, okay, we are not seeing any sign of improvement on inflation right now. Instead of raising rates, basically a double rate hike, which what was expected this month, they came out and said, we need to do a triple rate hike yesterday, and basically saying, we need to fight inflation. That's the number one priority. But what's not talked about enough, I think, is that the Fed is comfortable being so aggressive raising interest rates because they still are saying the underlying economy is okay. And I get people questioning that. How is the underlying economy okay when inflation is this high and consumers are worried? We'll show some data on it, but the labor market to me is the number one place you want to look for any type of positive news. Because we talked about this a little bit last month. If this truly is going to become a major recession, 2008 type story, where stocks are declining 50+%, you're going to have to see massive issues in the labor market. You're going to have to see unemployment pick up significantly. And we'll talk about why, A, that hasn't happened yet, and B, why we don't think it's necessarily going to happen, even as we go through the next couple of months. The big impact so far from rising rates has been in the housing market. And I think I've seen a lot of headlines on this because we basically had a 30-year mortgage that was at a 3% interest rate, just a matter of a few weeks ago. And now you're seeing the 30-year mortgage touch 6% in some places. That's a dramatic increase in borrowing costs. That's already caused housing sales to fall pretty quickly and likely will continue to fall. But again, the good news is, Chad and I were talking about this ahead of the call. This does not look like a housing meltdown in that you're going to see housing prices plunge and mortgages defaulted. You're in a situation where most homeowners right now have significant equity in their home. Most homeowners right now have a locked-in mortgage rate that's very low. And as a country, we're still tremendously underbuilt when it comes to total number of houses out there. So very little chance, we think, of a major housing market crash. Very little chance, we think, of a major unemployment spike. And we're following consumer spending very closely because another key is that, if we are going to go into a major recession, consumers are going to have to dramatically decrease their spending. And it's happening a bit on goods. We're not spending as much on goods, but we're spending a tremendous amount more on services than even 2 years ago. Restaurants, bars, hotels, sporting events, concerts are really looking at record sales and no sign of that going down. In fact, that's fueling higher inflation because the thought was as airline prices continue to climb for the summer, as gas prices continue to go up, the idea was people would stop demanding as much in trips, but that's not happening. We're traveling more than ever before. And despite airline prices jumping 15 to 30%, the planes are full. Everything is sold out. People are still hitting the road for summer vacations. And that's a bad thing when it comes to fueling inflation, but that's a good thing if you're worried about massive economic failure, which we're not at this point. So I want to dive into some of the details. And because this is such a nasty day in the market, I'm going to start with the good news first. I think last time around, I hit all the bad news and then finished with good news. This time, we're going to start with the good news. And I mentioned the job reports and the job situation as my, I think, biggest positive right now in the economy, because the left side of this chart shows the growth in jobs, call it over the last year plus. The dark blue bars are the number of jobs created per month. We're talking about hundreds of thousands of jobs coming back per month. Again, this is not consistent with a recession where you're not getting job losses. You're getting significant job gains above expectations. The question becomes, is this going to continue or is this going to fall? When I poll business owners, I work with a lot of small and big business owners. The number one thing I continue to hear is that our biggest issue is not that we have an inflated payroll and need to lay off people. It's that we don't have enough qualified workers to fill the jobs that we need. And, because of that, we are now in a situation where we're unlikely to see those jobs go away, but what we're likely to see is those jobs start to pay less. And that's actually a good thing if we see wages coming down. And how is that so? We want people to get paid less. A lot of people are confused by that line of thinking, but wage growth at the level that we've seen. And when you look at this chart here, the blue bars represent the 3-month percentage change in wage growth. And this average number is right around 5+%. That's the highest wage growth we've seen in a long time. So if you want inflation to cool down, you have to see people making a little bit less money, because the example I talked about before, if people are getting paid, in some cases, 10, 15% more, well, that has the potential to create what's called an inflationary spiral, meaning that you're getting paid more so you can afford the higher prices, you pay the higher prices, and it causes companies to continue to raise prices as needed. And you don't want that to happen. And that, in fact, this is something the Fed has talked about. One of the goals of these rate hikes is to get wage growth down to a more moderate level. You kind of want to see it maybe in the 2 to 3% range. And I think you're going to start to see that happen before you get a lot of layoffs. Companies are just going to start saying, hey, we have these job openings still, but we're not going to fight on price anymore. And you're going to see that happen. Wages fall before layoffs happen. The job situation continues to be good in the US. And this is the other big positive, household finances. So when you look at two parts of this chart, available cash in money market funds, and this shows bank deposits as well as government money market funds, we still are sitting on record cash piles. Now, this data is as of the end of March. If you fast forward through today, these numbers have come down just a little bit. So it means that we've started to dip into our savings a bit. And again, if you see headlines that consumers are taking on more debt, dipping into their savings, those should not necessarily be looked at as purely negative news stories, because we had these overinflated savings rates, overinflated piles of cash. And look at the debt service ratio here on the right. This is the percent of debt payments to our disposable income. And notice back in 2007, I keep hearing parallels to 2007, saying this is going to be another 2008, but this is a completely different situation from consumer financial perspective. You just do not have consumers with a debt issue right now. And even though consumers are starting to take on a little more debt, to cover higher inflation, to keep spending going, that debt is not at warning levels at this point, not even close. So to me, those are the two big positives that make me think this is not going to become a major, 2008 type recession, but volatility is still going to be here. It is a nasty news cycle, one that's pretty devoid of near-term good news. One of the things I really want to debunk today is the idea of the word recession. I see this getting thrown around, almost hourly. We're going into a recession. We're already into a recession. But recession is such a broad term. For those of you who are not familiar with the official definition of a recession is 2 consecutive negative quarterly changes in GDP. And what this shows is just the history of GDP since 2019. You can see the economy was growing at a slow pace, 2%, 3%, 2%, 2%. Then the pandemic hit. This 31% decline, obviously is something we've never seen before. And then we had the 33% recovery. Basically, the pandemic recession was reversed almost in the matter of a couple of months. And then you can see the economy has continued to recover up until the start of this year, where we had a minus 1.5% growth number. So if the second quarter comes in, where even if our economy declined by 0.1%, that's an official recession. But it's very important to note 2 things. One is the size and scope of the recession is so important. A mild recession, like what I think we're projected to be in over the next couple of quarters, is not necessarily a huge deal historically. It's consistent with stock returns in the minus 20 to 25%. and we're basically already there. A major recession is what we're not worried about right now. That's a 2008 type scenario. That's where the economy is declining by 5+% a quarter. And the other thing with GDP that's important to remember is there are components of how our economic growth is calculated. And this breaks down the first quarter of GDP. And I hear this quoted a lot. Our economy declined in the first quarter. But look at the first quarter data. Consumption actually grew by 2.1%. Business investment grew by 1.2%. But the net trade number was a minus 3.2%. So despite what the headline number is, you really have to look at these economic reports and dive into the details to find out how really bad the news is. Because this first quarter GDP report, I would argue that the first quarter news was actually good because consumption and business investment went up. This net trade can fluctuate a lot. One of the reasons that net trade declined so much is because the US dollar appreciated in value. When dollars become more expensive, American goods, products, services become more expensive to the rest of the world. And then the opposite is true. When dollars are more valuable, we are able to import more, for each dollar than we were before. And net trade means we imported a lot more than we exported by a wide margin. So, why I'm going into this detail, again, is just if you hear in the news, we are going into a recession or we're in a recession, that does not necessarily mean an economic collapse. In fact, if we go into a mild recession and that's all it is, stocks may even be undervalued where they're at now. So let's go a little bit into inflation. What is causing the dramatic spike in inflation this year? And I've highlighted 5 different forces that are really pushing prices. And the red ones are the ones that are hitting the hardest right now. One is you have the Russian-Ukrainian supply shock here at the bottom. This has been something that has been consistent all year, increased oil and food prices due to disruptions. And that's tough because there's not necessarily much the US can do in the short term to dramatically change the game on oil prices. Now, you could argue that politically we could make moves to pump more oil, but that isn't something that's a longer turnaround, especially on the refining space. And even if that were to happen, the amount of additional oil produced in the US is probably unlikely to make too much of a dent. You see the US, and again, I don't know if this is right policy or wrong policy, but you see the US is trying to get Saudi Arabia and OPEC to really increase production, because that is the one thing in the short term that really could bring down oil prices. 2 things, when you look at the price of oil, it's all about global supply and demand. And right now, the global supply is less because Russian oil and gas is not hitting markets. So the only way in the short term to bring oil prices down is allow Russia to produce and sell their oil globally, which is not something the West wants to do right now, or get the supply up through other countries, like Saudi Arabia. I don't know how the negotiations with Venezuela are going, but again, these things are not looking great for near-term energy prices. And same goes with food. You got a lot of wheat, corn, fertilizer coming out of the region that's not hitting global markets. And the problem, we talked about this last month on the inflation story. I told you why inflation was likely to stay high, because the non-sticky inflation areas like energy prices and food are less controlled by things like interest rates and Fed policy. Same thing goes with the supply bottlenecks up front. If China's locking down on COVID and goods and factories are shut down and products aren't getting hit and there's less supply, well, that drives down demand, and there's not much you can do about it if you're the Fed or the US government. Now, where does the Fed and the government have the ability to bring down prices immediately? It's these 3 areas here in the middle. And you already see some of these turning green. Goods sales are going down. Demand is going down for buying things because we have less money to spend. No more COVID stimulus coming in. When interest rates go up, try going to buy a car right now. You went from basically being able to borrow free for 5 years So now those interest rates are a little bit nasty when you look at a 5-year car loan if you're financing most of it. And cars is one of the areas that we've seen the highest inflation over the last year plus. You will see car prices come down. You will see deflation in autos. But it takes time for that to start to hit. So you are seeing some of the effects of lower demand for goods, but unfortunately, you're seeing increases in food, energy, and rent that have caused inflation not to take a dent. Well, the other one we talked about a little bit is reducing the labor supply. So what you're looking at with labor is there's not many workers looking for jobs, and you have 12 million or so job openings out there. To get workers, you have to pay more. You have to increase wage growth. So we have this mismatch between number of people looking for work and jobs available that's causing pay to spike. If you start bridging the gap where the number of people looking for work is matching closer to the number of jobs open, you don't necessarily have an unemployment spike, but you get wages down. We talked about that already. So the idea there is, get inflation down. But a point I want to bring up is consumer inflation expectations are so important. And it's funny because inflation can become a self-fulfilling prophecy. If we all think prices are going to go up, they usually go up. So the Fed is being aggressive to try to fight these expectations. That's why you see the Fed being more aggressive than before. What you're trying to get is the long-term inflation expectations aren't bad, but look at how high even next year's inflation expectations are for consumers. Consumers are more negative about near-term inflation than any time since the early 1980s. So those expectations have to change. And it's hard for them to change until you see real declines in prices. So you will start to see them, but unfortunately, it still may be a few months before we really start to see a dent in inflation. And we showed this chart last month, our price index with forecast, and you saw the 8.5% number last month. Well, we still had an 8+% number here. So there hasn't been any sign of this inflation coming down. It's likely to come down, but you're still going to be looking at 5.5% inflation by year end. So inflation is still going to be one of the biggest issues ahead. And we'll talk about, we feel we're invested pretty well given this forecast. I'll hit on that towards the end of the presentation today. So I talked about this with the housing market. Look at the 30-year fixed rate mortgage. We're now close to this 6% level, whereas just a few weeks ago, we were down to 3% on the 30-year fixed. And look at the monthly mortgage payment. This is assuming a 30-year fixed mortgage with 80% financing, 20% down. This is 51% higher than a year ago. And this number through today, I think, has hit close to $2,000 a month for that monthly mortgage payment. Talk about something that's going to put a dent in housing. It's this right here. You're just not going to see the same number of buyers that you saw a couple months ago. Even with a similar amount of total demand, you're now pricing out a lot of potential home buyers. But this is what the Fed wants to see. And why is this a good thing if you ask the Fed? Well, we know what the housing market was like. It was completely out of control. In almost every market in the US, you had a situation where there's not many homes for sale, and each one of those properties going up for sale had multiple offers, sold in less than a month, multiple offers over asking, dropping appraisals, dropping all sorts of contingencies. That is not a healthy housing market. That's an overheated housing market. That's not what you want in a high inflation economy. So this is the first thing you'll start to see is housing prices. We think housing prices will remain somewhat in line, maybe come down just a little bit. But what you're not going to see is the explosive growth in housing prices right now. And I think I saw this coming in a lot of ways where I would talk to clients about investment portfolios, and you say, oh, why would I invest in stocks when I can just buy a home, rent it out, and see that property appreciate significantly over time? Usually that's when you start to see the peak in housing, when people are talking about home buying as a guaranteed way to make money. And unfortunately, that's unlikely to be the case going forward with these housing market dynamics. Now, we've talked a lot about the Fed so far, and we talked about this a little bit last month, but this chart is an up-to-date view of, where do we see Fed funds futures, and what are the Fed's projections for interest rates going forward? So obviously those projections and forecasts have dramatically gone up in the last year. And fast forward to today, you can see it's almost like a stairway. The Fed continues to increase their interest rate expectations. And with the report yesterday, basically add one more stair onto the staircase of going one level higher on where the Fed wants short-term interest rates to be. So you're talking about a dramatic change in the government from, we're talking about the Fed and Congress going from doing everything they can to fuel the economy to now doing everything they can to cool down the economy. And we just talked about interest rates, but this is the other component, the Fed balance sheet. If you remember, the Fed not only has kept interest rates low, but they've been buying bonds to hold on their balance sheet to help keep long-term interest rates down to the tune of $9 trillion on the Fed balance sheet. So the plan going forward is the Fed wants to get the balance sheet back down to where it was before the pandemic, in the $4 to $5 trillion range. And again, they're going to do this slowly. You see another like staircase-like effect here, where the Fed is going to slowly reduce their balance sheet. One of the ways they do that is not necessarily selling bonds, but not reinvesting the interest that they collect on these bonds, not reinvesting the principal when bonds mature. So think of the government as just like an investor here. The government has all these bonds, they're collecting interest, and instead of reinvesting the proceeds from interest that comes in, it's maintain the cash and lower the balance sheet. So all of these things, reduction of the balance sheet, raising interest rates, stopping with stimulus, and hopefully we don't get any more government spending to go along with it. This has went from an easy money economy to a tight one in a hurry. And this causes volatility in markets. So when we talk about next, kind of what we want to do in a market like this, I added this slide at the last second because I think one of the most tricky things about investing in these markets is you see huge swings. Yesterday, when the Fed announced a 75 basis point rate hike, the market was up close to 2%. It was well-received news. That's exactly what we wanted to see. And then fast forward to today, as of the time I jumped on the call, the market was down about 3.5% on the day. And why are things moving so quickly and so fast? Well, I list a bunch of different factors here that lead to higher equity volatility and downside risk. You have quantitative traders and hedge funds. If you've seen any of Michael Lewis's work, you'll know that there are a lot of funds out there that are trading stocks and bonds on a minute-to-minute basis. High frequency trading is what it's called. And in a market like we have now, when you have stocks like Apple and Microsoft and Facebook and Google and Amazon, that 5 stocks alone represent 25% of the overall stock market, it doesn't take much to have a 3 or 4% down day if you have a bunch of hedge funds moving in and out of positions. At the same time, you have leveraged vehicles here on the left. You have funds out there that are taking on 3 or 4 times the risk of the overall market in both directions. And in days where you have a bunch of selling, these funds have to maintain their short positions in the market or their long positions in the market on good days. And you have bigger swings because of this. So not only do you see a lot of headlines that are going to cause volatility, in a previous world where you didn't have hedge funds and algorithmic trading and leverage vehicles and a very high correlated market with only a few stocks being as big as they are, you wouldn't necessarily see the swing. So the last thing you want to do is be trading into these markets against some of the quantitative traders. We always go back to that 6 to 9 month view. We think we can really predict where things might be going over a longer period of time. Very dangerous to try to time markets in the short term. So what do we do from here? As of this chart, we're showing a 16.5% return in the negative for the S&P 500. Fast forward to today, we're down over 20% on the overall S&P 500. We are officially in a bear market. First off, we know that history says staying invested or getting cash to work in a bear market has historically been a very effective decision. It has always worked out to be an active investor in a bear market period. And it's usually the better times to buy when it's peak fear and worry. And I would argue we're getting pretty close to peak fear and worry, but it's still unsettling. So what are we doing to try to navigate some of the risk right now? And our main focus right now is quality companies. I can't reiterate this enough that clients who are working with us currently will not see any investments in electric vehicle stocks like Rivian, Lucid, and Tesla. You will not see any speculative technology investments in companies like Peloton, DraftKings, Roku, Netflix, cryptocurrency companies. We could list 100 different high growth companies that have been the best returners over the last 5 years that are down now 60 to 95% over the last 12 months. 21% down on the market sounds like a lot, but compared to the NASDAQ, compared to very high growth technology funds like the ARK Innovation Fund, those funds are down 50+% on the year. And by focusing on quality stocks, like dividend stocks, like higher quality investments in companies like Home Depot and Walmart and Microsoft and Visa, companies that have very high quality sustainable earnings, that gives us a ton of peace of mind in a volatile environment like this. Because, as early as end of last year, we were getting so much pressure from investors. Why is CNR not looking at electric vehicle stocks? Why is CNR not looking at clean energy stocks? Why are we not looking at cryptocurrency companies? I was called a dinosaur by some clients for not going into these areas, ignoring the potential growth down the road. And we just kept saying the valuations, these are exciting companies. A lot of these companies are where the future is going, but the valuations were not reasonable. You can't buy stocks that are trading at 100 times earnings when interest rates go up. And that's exactly what's played out. So we do feel comfortable staying invested in high quality stocks, but now is not the time to chase the highest growth stocks. So you see the top of the line here, it says shifted to neutral equity weight, overweight US stocks. And what that means is, say you're a moderate investor. A moderate investor often has 60% in stocks, 40% in bonds. That's about where we want to be positioned. But what's different about our view than others is I mentioned the tech stocks, avoiding those. Also, we're very light, if not completely out of international stocks for most clients. To us, now is not the time to bet on Europe or Asia. The geopolitical risks that Europe and Asia are dealing with are much higher than what we're dealing with here in the US, in our opinion. And we think that will lead to much less corporate profit growth in those international companies compared to the US. That's what this chart is showing. It's showing the next 12 months earnings per share estimates. You can see the S&P 500 is favored to be much more profitable than the other international indexes listed here. So again, it's a pretty simple story to me. Give me stocks in US companies. Give me stocks in companies that are profitable, making money, not seeing profits deteriorate despite tough conditions. And it's really hard to see those stocks being lower in value 12 months from now, 24 months from now. And that's the way we want to play this type of environment, because it's always very dangerous to get conservative and go to cash at a time when you've hit the bear market, because it's almost impossible to try to time the bottom. And history says if you're selling out of quality companies and going to cash, you're not going to time it right to get back in. And actually the same goes with bonds. So I just have another slide or two to cover, and then I'll take questions. But the bond market has also been a big issue this year. Normally in a downturn, stocks get hit, bonds hold up. In 2008, you can't even see 2008 on the bond return list here, because bonds were down 1% and 2% when stocks were down 50. But look at this year, traditional bonds are down 10 as well. So there hasn't really been a place to hide from the risk this year because bonds and stocks have been equally hit. But that said, I think bonds become a lot more attractive for more conservative investors right now as interest rates go up. So, if you're a conservative investor right now, if you're a moderate investor right now, we are looking for some opportunities to pick up quality bonds that not only have declined by 10%, but are now, instead of paying 1, 2, 3% interest, maybe paying 3, 4, 5% interest. And as inflation comes down, we're likely to see a time when bonds beat inflation again. And that's what I'm referring to right here. When you look at, the percent yield in some of these bond categories right now, traditional municipal bonds right now, traditional corporate bonds are now back over the 4% range. And those are even a little bit higher as of today. And then high yield bonds, another area where, instead of getting the 4% interest rate, you're looking at 7+% yields on high yield bonds and buying them as a discount. So for, again, moderate conservative clients, bonds finally will pay again. And you'll actually start to see banks advertising CDs again. Just give it a few weeks. Banks are probably in the process of, offering 2, 3, 3.5% CDs again. And that's the fallout of interest rates going up. So Chad, I know that was a lot of information, maybe gone just a little over the time, but definitely wanted to go through all of that. And now we'll take any questions that have come in.
All right. Thanks, Robert. I'm gonna start off with a couple here as we give some people some time. So again, if you didn't hear at the very beginning, at the very bottom of the screen, there is a question and answer little tab, and feel free to just ask some questions as we go. I think one of the big questions we get, and as people we're talking with clients, is they're like, "Hey, we're really worried about the markets, and we want to protect against inflation." So, can you tell us, what do you think? Could you have any input on, what you say is kind of the best assets to fight inflation, and kind of what I'm assuming you're getting that same question.
Yeah. So, I get questions about inflation protected bonds as a way to protect against inflation. But remember, those are already taking into account current inflation. So the only reason to buy treasury protected bonds at this time are as if you think inflation is going to get a lot worse from here. So first off, if you're thinking of that category, I would highly argue against that, because instead of that, you can invest in some of the bond categories I have on the screen here, pick up much higher interest rates and then benefit as inflation comes down over the next couple of years, because inflation is not going anywhere, but it's not going to be higher 6 months from now than it is today. It's just not, because that is what the Fed is doing. There's just so much aggressive interest rate hike happening that you're going to see inflation eventually cool down. So our play right now, again, higher yielding bonds that are floating rate in nature have been good, because when interest rates go up, those bonds reset their values. That's been one area. And also companies that make a lot of money and have pricing power. That's your best long-term inflation hedge. And the stocks that we've been buying, like Procter and Gamble and Coca-Cola and utility companies and some select energy companies, have been great inflation hedges because they've been able to raise their price without changing their revenues much.
Good. Another question kind of coming up is, you had mentioned kind of the slides from back in 2008, kind of comparing to where we are today. Because I know you and I have had the conversation multiple times, just looking at, the beginning of 2008, when interest rates were rising pretty significantly, and that had already driven the stock market down 15, 20% in the, from September of 2007 and going forward. Interest rates going up and the market going down. But, then we saw with Bear Stearns and Lehman Brothers going bankrupt. How does this kind of compare to what we saw back in 2008, and kind of diving in? I don't know if you have that speedometer from 2008 that we could even look at.
Yeah, well, I can't pull it up just off the top of my head here, but I'll go back to this page, because what happened in 2008, why it was so different, is you had a major economic crisis that was coming, and it wasn't fueled by inflation or interest rates like this one is. It was fueled by a consumer debt bubble in the housing market. And then that had basically an avalanche effect where, you had, banks and, companies, investment firms like Bear Stearns and Lehman collapse. And then you had the Fed go the opposite way, which is take interest rates to zero. So bonds benefited. You had the aggressive financial response. Why this is so different is we're coming off of a super hot economy where we're being hit by higher inflation. And now the Fed is trying to, get the economy to slow down without taking us into a major recession. So there's not really a precedent for this situation we're in right now. If you go back through history, I get a lot about the 70s and 80s with stagflation. And that's a question that comes up a lot. But the big difference there is we had very, very high unemployment. That's the thing we need to watch the closest right now is if the only thing that's going to cause this to become a much worse economic situation is if we get a dramatic shift down in the labor market. And right now we just have such a strong labor market that to us, it's hard to see, we want it to cool down a little bit, like we talked about with wage growth, but it's hard to see massive unemployment outside of maybe some of the hardest hit tech companies. Again, the companies we talked about not investing in, like the Teslas of the world and the cryptocurrency companies and the very high growth tech, that's where you're likely to see some layoffs. But I can tell you, for a lot of these people who are losing their job, software engineers are probably the most in-demand position right now. I can tell you that Apple, Google, Facebook, Amazon, and Microsoft will pick up any of these employees overnight if they become available in those sectors. So to us, I think, it's pretty important to watch the labor market and no real signs of stress at this point.
Great. So we had a good question kind of come in, and this is kind of comes into a conversation we're having with a lot of our clients right now where we know we have had cash on the sideline. We've been kind of waiting and seeing. And the client question is, with City National Rochdale, cash comes in. Are you guys saying, hey, this is definitely a good time to be buying, or is this something more dollar cost average over fill in the blank how many months?
Yeah, I mean, that's a great question. We like the dollar cost averaging over, call it 8 weeks or so. So think 2 to 3 months of averaging in. And why we like dollar cost averaging with new cash as opposed to just backing up the truck and putting it all to work right away is because the near term, like we talked about, is going to be shaky for the next 2 to 3 months because it's tough to see a bunch of good news catalysts that would drive stocks, back up 15% in a month. Because as we talked about with inflation, that's the thing causing the most market stress right now. And I think we're 3 months away for, really some of that inflation starting to turn. But at the same time, this is where our research team comes in. You got some really high quality companies that are down 20% plus on the year that are trading at very cheap valuations. Look at something like, a lot of the big banks that we like, JP Morgan, Bank of America. Well, these banks benefit from interest rates going up. Let's not forget that banks actually can start to make more money now that rates go up. And their stock prices are just downright cheap compared to the rest of the market. I mean, if you looked at this equity market valuation for the financial sector, it'd be totally green because you got someone like JP Morgan trading at 9 times earnings. Bank of America trading at 8 times earnings. They're paying you a 3% dividend. These type of stocks have a natural floor. There's only so far they can go down before they become just an ultimate bargain. So those are the stocks we like to pick up right now, are the ones that are super cheap. They pay a dividend, and there's a floor in that these stocks really can't go down 80%. Whereas a company like Zoom, I get questions about, should I buy these superstar tech companies that are now down 80%? Well, Zoom is still a $20 billion business if you look at their price, and they're not making much profit at all. It's really hard to guess if Zoom should be valued at 20 billion, 40 billion, or 4 billion. So even though a stock like Zoom is down 80%, it's easy to make the case that it could be down another 80%, even if it doesn't really do anything wrong, because it's more of a guessing game with what those stocks should be valued at. Whereas the stocks like a JP Morgan, like a Home Depot, like a Walmart, like an Apple, you really can project how much money they're going to be making over the next couple of years. And you're not taking as much risk, and you're getting to buy quality companies on sale. I always like to say these bear markets are when you want to pick up your favorite stocks when they're 20% off, the stocks we know aren't going anywhere. You know, if you're an individual investor and you're like, man, I wish I bought Amazon, I wish I bought Nike, I wish I bought Apple, and I just never pulled the trigger. Well, there's your opportunity, because you know these stocks are going to be strong for a long time. And I always talk about quality brands too. Quality brands hold up. If you have a strong brand like an Apple or a Nike or a Starbucks or a Microsoft, you know, those are the companies that typically have a, you know, higher floor, in that there's only so far they can come down before their stock prices come up again. So long answer to your question, Chad. I do think there's opportunities now, but you want to spread that risk over a couple of months.
Yeah, and I think one of the things you always point out too is the fact that, again, you're looking at 6 to 9 months down the road. So it's at this point, as far as getting invested, this is a time where I know we've been talking about that, getting cash to work right now. When we're looking, I used to say, listen, if this is money you're not touching for 3 years, this is going to be one of those opportunities we're going to look back and go, this was, you know, a very good opportunity to buy some really good companies at a good discount. Good. Well, I think we're kind of getting up on the end here. So I want to thank you for your time and thank everyone who attended and watched. Again, we'll have this recording available on Monday when we send out our email. So please feel free to watch again or share it. And Robert, thank you. And we'll see you again next month for our next video.
Yeah, looking forward to it. Thanks so much, everybody.
All right. Have a good day, everyone.
Bye-bye.